Welcome to Tax Insights, presented by Hawkins Ash CPAs.
And good morning, listeners. Welcome to Tax Insight here on WOMT 1240 AM, 107.9 FM, and online streaming anytime at WMTradio.com. We're with Jeff today from Hawkins Ash. Jeff, good morning, sir.
Good morning, Terry.
How's tax season going, my friend?
You know, it's going all right. It looks like as of today, there's about 2 weeks left. So at least till the April 15th deadline, which is what we still consider to be the deadline. So
Yeah.
we're trying to get as many returns out as possible.
Good for you guys. Today, Jeff, on the show, we're talking about medical expenses.
We are, because, you might ask yourself, why medical expenses? With the very low rates of taxpayers who actually itemize, and the even lower amounts of people that have enough medical expenses to get over that 7.5% hurdle to make any of them deductible, there's very few people who actually can benefit from the medical expense part of itemized deductions.
All right, so you got me curious. You got me sucked in here on this one. Why do you want to talk about medical expenses then on today's show?
Well, because, many people are going to benefit from a decrease in tax because of medical expenses. It just won't be because they itemize their deductions. It's going to be because they do things like, use their company's cafeteria plan, put money into a health savings account, or maybe even, their insurance is paying for more of their expenses than they have in the past.
So I know that we've talked about these before, but what is the difference, again, between the cafeteria plan and an HSA or a health savings account?
Yeah, let's start off with the health savings account, because these are allowed for people that have high deductible healthcare plans. And, normally you would think that any high deductible plan would work, but it's not the case. What you have to do is you have to talk to your employer because, you might have a high deductible, but that plan technically doesn't qualify for the HSA. Well, let's say that it does. If that plan does qualify, you might be able to put away $3,600 if you have a self-only plan, or $7,200 if you have a family plan in 2021. And you can even put probably more away if you're 55 or older. Now, the nice thing about that is that you can put that money into a health savings account, and you can get a tax deduction for it this year, even if you have no medical expenses for the year. Now, this can be done through payroll, or it can be done through, setting up a bank account with your, financial institution.
So what is then the cafeteria plan?
Yeah, so the cafeteria plan is a little bit different. It's called, Cafeteria Plan 125 plan is what it's also known by. These are available for employees who really don't have access to an HSA eligible plan. But like I said, their employer has to offer, this type of cafeteria plan. The difference here is that your employer is going to take money off of your paychecks pre-tax, which gives you the tax savings, and then you get that money back as long as you have medical costs for the year. But a warning, if you have more withheld from your paycheck than you actually have in medical expenses for the year, you could lose it. So that's why cafeteria plans are called use it or lose it plans.
Interesting. Okay, so did I hear this week that personal protective equipment, the PPP, can now be taken as a medical expense?
You heard right. So the IRS just announced recently that, PPE such as masks, hand sanitizers, sanitizing wipes, those kind of things can all be taken as medical expenses as long as the purpose for buying them is to slow the spread of COVID-19.
So what else can now be used as medical expenses?
So you can deduct most things like doctor visits, visits to the eye, getting eye care, dental care, those kind of things, as long as those expenses are not considered cosmetic in nature. So if we look at the dental side, artificial teeth, Terry, they
Yes.
count.
Okay.
Cleaning your teeth, that counts. But if you actually go in for teeth whitening, that's cosmetic. That doesn't count. For vision, most of it counts. Whether you have, your eye exams, whether you have glasses, whether you have contacts, whether you decide to do the laser eye surgery, that all counts, including supplies like your saline solutions, things like that. You might say, what about for moms? For moms, it can be like the fertility treatment, the doctor visits, even the breast pumps and the supplies that go along with that. But sorry, no diapers or maternity clothes are deductible. Now, Terry, having two daughters of my own, if diapers were deductible, I don't think I would have paid any tax while they were in that stage.
What about home improvements?
Yeah, so home improvements, that's something people don't think of. Because if you need to change your house a little bit to make, things wider or change your bathrooms or add different ways that, to assist somebody that isn't able to get up by themselves anymore, those kind of home improvements are actually medical deductions. Also, unfortunately, if you're addicted to like alcohol or drugs, you can also use the cost to attend those meetings or even inpatient therapy as a deduction. So, we could keep going on and on, but I have a feeling that we're getting close on time.
Yeah, we are, Jeff. What is the best way for listeners to connect with the team at Hawkins Ash?
I would go right to our website, which is hawkinsashcpas.com, or follow us on Twitter. We put a lot of things out also on Facebook.
Jeff, have a wonderful day, and we'll talk to you next week.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs. Part of your business, part of your life.